TheoTrade. This is Don Kaufman. It's February 17th, 2023. Just about 15 minutes left inside of the trading session here with the S&Ps listlessly down. I mean, look, hey, overall, this entire week, we're pretty much massively unchanged in the marketplace. But I got to tell you, some of the short-term volatility that we're seeing, even days like today, I mean, this might not look like much in the chart, but you know, you're down 40, up 40, back down, back up. It's what I term Mr. Toad's wild ride. And we're going to dig deeply here on this weekend's update to the specifics of why you're seeing the price action, well, that you're currently seeing in this marketplace. That all surrounds what has been the talk of the trading community this week. Should traders fear zero-day expiration risk? If you have absolutely no idea what I am referencing, well, you're going to get an idea here in just a moment. What I'm really referencing is, if you take a look at the SPX is often what I term, it's the mother of all products. But take a look at the SBUX, and one of the things that some of you may or may not be familiar with is, yeah, there's an expiration here on a Friday, and then there's an expiration. Look, there's no Monday because Monday the markets are closed, but there's a Tuesday, a Wednesday, a Thursday, a Friday. Okay, a Monday, a Tuesday, a Wednesday, a Thursday, a Friday. There's expiration every single day. And I got to tell you something about expiration every single day. Everybody is trading it right now. Okay, should you have any fear of it? Well, we're going to break that down because one of the things that people don't understand about all of a sudden this dramatic shift in trade, and the dramatic shift in trade, I'm just going to jump right into it here. The dramatic shift in trade has been towards these zero-day expiration, right? So yeah, we're going to talk about the markets in a moment here, but just hold on, because everything in the market right now is about zero-day expiration. And with only 15 minutes left to go, there couldn't be a better time to discuss this. Look, I'm going to open up here the 17th of February. Well, today is February 17th. Why am I opening them up? Because I want you to see. I'm just going to freeze the screen right here. Look at the volume. Okay, look at the volume. That's calls. And then, of course, let's take a look at the volume on the puts. Okay, it's insane. I mean, there's nothing else to say, but oh, don't worry. The at the moneys have traded 400,000 contracts. Do you realize that the open interest from last night was only 12,000? That basically means everybody's opening options and closing options and opening options and closing options to the amount of, well, it's just absolutely wild. Look at these 405s. They traded 500,000 contracts. Okay, and you're looking at this. It's absolutely, you know, spellbinding. It's incredible. Like hundreds of thousands of options are trading, and that's the spiders. And the spiders are like, a little bit of a peanut, right? Yeah, a little peanut until they actually trade what? Oh, they're going to do clear up to what? About 9 million contracts. But then let's get to the mother of all products, the mother of all products, which is the SPX. The SPX is good for about 2.5 million contracts. But remember, the SPX is 10 times the size of the spiders. So when you look at like, didn't do the 8 million or 9 million the spiders did, that's right, the spiders did about 9 million. But on a notional value, okay, add a zero to the end of this. Instead of looking at like 2.5 million contracts, did like the equivalency of like 25 million contracts. It's absolutely sick how much volume is trading in here. And yet most of that volume, oh wow, this is chaos right now. If you take a look at the volume, it is all in the expiration for today. Now I know you're like, it's Friday, of course it's today, right? Yeah, but this has been going on now every single day. And there's a lot of talk, you know, in the community that it's going to cause Volmageddon Part 2. Got to tell you right now, I don't necessarily disagree with that. But here's the most important thing. You, as a trader or an investor, I don't care what walk of life you come from, better understand, okay, why zero DTE, that's days to expiration, why zero, okay, expiration options do absolutely unequivocally cause a tremendous amount of risk, especially when we're all trading them in the very near term. The other aspect that's, well, a lot of insight to you. You can pretty much throw everything you've ever known about technicals out the window when you're talking about zero-day expirations, because it'll throw off everything. No one cares about anything with zero-day expiration that isn't right out in front of them. Okay, your memory with zero-day expiration is an hour from now. That is it. You can remember the past hour and you're looking out maybe an hour ahead of you, but you couldn't care less about what's going to happen tomorrow, what's going to happen on Tuesday when the markets reopen. No one cares anymore. And that is one of the primary reasons that this market, people, has become an utter free-for-all. And of course, everybody goes, it's rallying. Yeah, well, until, of course, you know what, the last 2 to 3 weeks, and if you bring up auto expected moves, effectively now you're in your third week. And that third week of there's 1, there's 2, there's 3 rallies over. Okay, we're just basically moderating to the side over here. As I said, you know, the markets as a whole, they finished the week massively unchanged. When I talk about massively unchanged, let's go to the SPX for what massively unchanged means. Well, we started here and now we're here. All right, they're down mildly. But nevertheless, if you look at the QQQ, the NASDAQ 100, I bring up auto expected moves. The Qs actually finished the week very, very slightly higher. And from a sector point of view, it's the only sector that really got clobbered this week. Whoa, wow. The energy sector tried for the corner and missed. It got hammered. I mean, that's a 2-3 sigma move. All right, push all of that aside now. Like, look, we got through it, right? We talked about massively unchanged. We reviewed a couple of sectors. Let's get down to business. Zero DTE risk becomes the talk of the trading community. And I'm only going to spend about 5-10 minutes on this, but it's critically important that you understand. My example for the 0-day expiration is going to be in the spiders. Now, granted, okay, SPX, a lot of this happens in the SPX, okay? A lot of this happens in the spiders, and unequivocally also actually is occurring in the S&P options on futures. You know, I talked a little bit a moment ago about spiders doing almost 9 million contracts, and then I looked at the SPX, which had like 2.5 million, but don't discount the S&P options on futures. Do you know the options on futures now, which are half the size of the SPX? Yeah, they're good for another, 700,000 contracts in there. Like, people, the volume right now is just huge by huge. And it's not about volume, you know, oh, he traded options that are 30 days out. No, no one cares about that anymore. All of a sudden, okay, we have become, I'm a fly. I can remember the next 7 seconds, okay, and the last 7 seconds. There's nothing but the right here and right now. Okay, so why is this, again, so critically important? It's what's moving markets right now, and it's not just making markets skittish. Look at the trade today, all right? We're down, we're up, we're down, we're up, okay? And if you just, hey, look, we started the day, and again, I'm going to put this in spider terms, we started the day somewhere around, like, we'll call it 106.5. You realize we sold off significantly. Like that's a big boy sell-off. Then we rallied significantly. That's 104 all the way back up to 107. That's good for a 30-point S&P rally. Then we dipped all the way back down, came all the way back up to the opening, okay, came all the way back down, and hit 107.5 before reversing down and ending up the day massively unchanged. And all of that is in the last 6.5 hours. That's not even counting, of course, some of the overnight trade, which would make you absolutely sick to your stomach. So one of the first things that you have to understand about 0-day expiration options, okay? As a trader, right? You're a retail trader. Let's talk about retail traders, okay, and market makers. So one of the things we want to talk about is retail, R, okay? And then we talk about MM. So you're two very different animals. Retail, okay, is typically trading with some type of a bias. They're getting bullish or bearish, or, okay, they could just be out there selling options or buying options, just hoping we make a very, very substantial move in one direction or the other. The market makers are actually going to do what's termed bona fide hedging activity. Now, for those of you that have absolutely no idea what a market maker does, the market maker effectively takes the other side of your trade. Now, of course, everybody turns around and they go, no, the market maker is the person that's there to screw me the most. But if you look at the options that you're trading in, okay, look at the options you're trading in. Now, look, there's just seconds to go in the trading session. Look how tight these markets are. When I say how tight they are, look, here's a market of 35 at 36. How is anybody, okay, you know what, I'm going to freeze the screen. Freeze the screen! How is anybody screwing you in any of these markets? The markets are spectacular. Look how tight they are. They're wonderful. Like it's utopia out there in comparison to, you know, what it was like 20 years ago. 20 years ago, the markets were like $3 wide. So it's all server-driven markets and it's really tight. People go, but they're taking advantage of me. Well, look, if you think they're overpriced, sell them. If you think they're underpriced, buy them. So I want to get that argument out of the way. But I want you to understand that the market maker Okay, so we have this retail trader. Whoa, we're all over the screen. We have this retail trader, and then we have this market maker. Okay, and the market maker is doing what they term bona fide hedging. So here in this example, if you turn around and you buy a call, okay, the market maker unequivocally is going to sell that call. Now, when you buy a call, you yourself are taking on what is termed positive delta. That's your bias. That means you want the market to go where? Up. Okay, well, the market maker in turn sells you that call, and the market maker gets to keep just a couple of fractions of a penny. Look, if the market's 31 at 32, okay, you're buying that thing for 32, they get to keep a fraction of a penny. If the market again is 31, okay, at 32, you're a buyer at 32. Well, they're a seller, okay, and they basically get to keep a little bit in the bid offer spread. So you guys cross the trade, you're happy, but the problem is the market maker all of a sudden now is short delta. How does a market maker offset short delta? As I said, they're what they term bona fide hedgers. Market makers want to offset all directional bias. They don't sit there and sell a call and they go, oh, I really hope after selling a call that the marketplace goes down, because if it doesn't go down, I'm screwed. Okay, they actually use high frequency algorithms, HFT, high frequency trading, okay, to ultimately neutralize their delta, right? So now they're net neutral. Does that make sense? Guys, that's one of the most important concepts. You buy a call and you're bullish, okay? The market maker sells you the call. They're not bearish. They're actually net neutral. How do they make money? You know, if you trade, okay, a few million times a day and you get to keep a fraction of a penny, let me just tell you something, and this is my own personal experience, that crap adds up. I spent time in the market making side of the business. I spent time, over 15 years in the brokerage side of the business, and allow me to tell you, we have routed, when I was at Thinkorswim and TD Ameritrade, we have routed tens of millions of trades to Citadel, okay? They're going to be okay, but they're predominantly net neutral. In fact, almost all market making firms have to trade net neutral because of what is termed the Dodd-Frank and specifically the Volcker rule, right? So they trade net neutral. Now, I want you to think about, okay, in context, what happens if one of these market making firms was carrying, okay, tens of thousands of option contracts? Okay, could that happen? Could a market making firm end up with tens of thousands of option contracts, a little bit here, maybe a little bit here? Of course it can happen. That's going to happen every single day. So what I'm going to do is I'm going to take you to the Analyze tab, okay? And I'm going to start with a trade. And again, this is going to be a little bit, it's going to be a little bit out there for some of you. I want you to imagine, okay? Just bear with me because I'm going to highlight this. I want you to imagine that a market making firm like Citadel, okay, was long, short, but long, okay, 10,000, and this is a strangle, okay? This is just the 407, 408 call, meaning that they bought the 408 calls and they bought the 407 puts. Now, most market making firms, it's not going to make a difference in my example whether they bought the options or they sold the options, okay? What I want you to implicitly understand is how the hedging actually works, because that's what this is about. So what happens is the moment that these market makers start loading up on inventory, and that's exactly what happens. This is their inventory. They're currently like net. They got 10,000 options on either side of the marketplace. They have a huge amount of theta decay against them, but they want to neutralize all of that directional risk. So how many deltas do they presently have on? Okay, and you can see the delta risk in here. You're like, oh, it's about 60, 70,000. So what the market making firm is going to do, okay, is they're going to go out and either buy or sell stock. Now, why are they going to do that? Watch this. We're going to come over here. We're going to analyze a trade. I just threw some stock in here. Okay, how many shares of stock do I need to actually neutralize this position? Let's say, well, let's type in 8,000. They go, oops, you missed it. You missed a zero there. Yeah, intentionally, right? So all of a sudden, okay, I put in like 80,000 shares of stock. Now lock that price down. Before you know it, okay, that trade, oh, it's out of balance again. Now we're long 40,000. So what do they need to do? They need to turn around then, okay? Here, let's actually neutralize it. There, okay? So now we're basically net neutral. So time out, okay? Time out. I neutralized the position. How did I neutralize the position? All I did is took, all right, 10,000 contracts of this option trade. And 10,000 option contracts, either you're thinking it's a lot, but hundreds of thousands have traded today. And then I had to take 40,000 shares of stock to basically bring my delta very close to net neutral because they don't want to incur any directional risk. Now, again, everybody's thinking about, they're going to lose money, they're going to make money. Don't worry about that portion. Just understand at this point that they have to actually hedge with the dynamic of the marketplace. Now, the second I unlock the screen, their delta, oh my gosh, it's out of whack again. So now they're going to have to go in here. They just bought 40,000 shares. Now they're going to have to sell almost 8,000 shares. So they go back, they use a high frequency algorithm, okay? And they come in here to analyze the trade, okay? And now they have to sell. Well, now we're up to about 10,000 shares. So they turn around and then sell 10,000 shares to neutralize their position. Now, time out. Do you understand what they're trying to do? They're constantly trying to neutralize the position. That's it. Okay, let's not worry about the theta. Let's not worry about the gamma risk. The gamma is what's driving the delta. Oh, wait, by the way, stop everything because we have 7,000 deltas of risk again. So we're going to have to go get long 7,000 shares. Okay, there is the closing bells of the trading session. So I just wanted you to see, okay, the dynamic of this market making firm that's just basically trying to neutralize their directional risk. Now, here's where things get a little bit crazy. Okay, where things get crazy is, let's say, let's knock this out, okay? Let us say, for example, that the market starts to rally a little bit. So what I'm doing here is I'm synthetically, watch right there, okay? Right in this area right here, I'm actually causing the marketplace to rally. And the more the market rallies, what is it doing? Okay, the market is actually creating huge amounts of delta risk, okay, which inevitably I am going to have to turn around and start to hedge, okay? The hedging of that position is actually going to move markets, okay? Now, market making firms are going to do this with extraordinary size positions. I'm just doing 10,000 contracts. I just wanted to show you, right? A little tiny rally, like a dollar rally, all of a sudden you're sitting on what? Hundreds of thousands of deltas of risk. How are those deltas of risk really going to be laid off? Most of the time, those deltas of risk, okay, are going to be bought or sold using S&P, okay, futures contracts. They're going to use the futures contracts, which is one of the reasons we actually look at the futures contracts, because one futures contract is the same as 500 shares, okay, of SPY. So whether you're trading the SPX, whether you're trading SPY, or whether you're trading ES options on futures, the hedge is predominantly going to be the S&P options on futures. And the hedging activity, okay, is actually going to perpetuate these wild moves in the marketplace. Then all of a sudden somebody comes in, okay, and unloads huge amounts of options, okay, and it flips the delta right back around, meaning that someone will actually come in and you're like, you're long like 10,000 triangles. Somebody comes in, whacks the size of that position, for instance, okay, to 5,000. All of a sudden the delta gets cut in half and actually causes sell side activity in the marketplace. What you have to think about, okay, in this particular context, and it's wild if you've never seen this before, but what you have to think about is, okay, there is nothing ahead of you except there's buying and selling of these options. And the buying and selling of these options is actually causing, like, we're up, we're down, we're up, we're down, we're up, we're down. So the real fear, and this is what has been discussed in a whole lot of extent in the last couple of trading sessions, right? People are talking about like, oh, this could actually create some Volmageddon once again. Yeah, they're not far off, because what can actually happen is when you actually start neutralizing positions in this particular fashion, as soon as the marketplace starts to run one way or the other, okay, most traders actually have to hedge in the dynamic of the marketplace. And I'll say that again, most traders actually have to hedge in the dynamic of the marketplace. So in effect, okay, if we start selling off big, you're actually going to get everybody selling into the selling. All right. And at the same exact time, you're going to have traders that are relinquishing and dumping, for instance, some of their options positions, which is only actually going to further complicate the issue. Okay. So there is absolutely no question that in current market times, all right, the 0-day expiration is in fact going to perpetuate a critical amount of risk. Now, this is something like, years ago, you call it a gamma squeeze. Okay. It has everything to do with gamma. Okay, but right now, in the shortest duration possible, this risk can be quite phenomenal. Now, I'm actually showing you in my example, okay, if the market making firm traded the long side of options, but net, the market making firms, here's the bottom line, okay, they're long, they're short, Okay, all they're basically doing is just trying to neutralize the delta. You imagine these market making firms, they're not trading two options. Okay, they're trading possibly thousands of different strikes spread across, okay, 0-day expiration, spiders, SPX, S&P options on futures, VIX. They're commingling all of those trades, okay, trying to neutralize the delta. But most of the time, again, they're hedging in the dynamic of the marketplace. So here's the real fear. Okay, the real fear is all of a sudden the marketplace does start to come down. Maybe it's news that kicks it in. Okay, there can be like a break point. If you look at trading as like a standard deviation, we start to sell off a little bit, and all of a sudden we crack through like a one deviation move, and it accelerates us considerably. We crack through the second deviation, and we're off to the races, and all of a sudden you start to get this wild and fat-tailed move. Okay, right now, well, we haven't seen that. It's coming. There's no question that it's actually coming. Again, everybody, jumping the exact same boat. What's basically occurring is, if you think about, well, I think this is a fairly good analogy as well. If you think about dynamic hedging as a boat, all the people in the boat, you want them nicely scattered around. Well, the way that dynamic hedging actually works, and the way that, the suppression of volatility is, all of a sudden, everybody actually runs to one side of the boat. That boat is going to flip, and it's basically the exact same thing. Again, being the shortest duration expiration, it is dangerous. There's just no question about it. The amount of volume, okay, in here it's perplexing how large it really is. You look at the end of the day, and it's just awe-inspiring to see, like, why are 70,000 contracts actually trading here? Why are 50,000 contracts trading out here? And the answer to that is, it doesn't matter. You just know that it's perpetuating this immense amount of risk. But for right now, we're just caught like, a rat back and forth, because all of the hedging activity at this point, okay, is just pinging us literally back and forth until we get one of those moves that all of a sudden, we're just pinging back and forth in this one deviation. We cross through one deviation, we cross through two deviations. Before you know it, we're off to the races. And that's exactly what hedging activity can drive. So yeah, it's going to be some wild times out there. You should absolutely fear some of the 0-day expiration risk. And hey, as a retail trader, one of the most important things, do not get caught short 0-day expiration, meaning that don't sell short duration options, or eventually you will suffer the wrath of a 3, 4, even 5 sigma move. All right, next on the docket here for this weekend's update, get your trade on, this week's profit and losses. Look, one of the things that I did a lot this week, some of the sell side activity, it really it opened up the door for, I closed this, I closed some of this, and what is this? I'm just buying back short calls, just a little bit of sell side activity. Okay, really generated some nice premiums for me, but I closed a bunch of calls for profits. The other thing, and I talked about this on Wednesday night, I actually opened up a new catapult, S&P options on futures versus StarBUX. That is, I basically went out, okay, and built me a nice position, and my position happened to include a spread on StarBUX against, and I sold, okay, options in the S&P options on futures to finance the StarBUX trade. So imagine that I went out and was able to buy this nice big 10-lot trade, okay? So I shouldn't say 10 lot, I apologize. A $10 wide spread. This is a 3-lot in this particular account. I do apologize. I'm actually spread up into multiple accounts over here, but this is a nice $10 wide spread. Okay, this is 3 contracts, all of it. 100% of that was actually financed by the sale of an S&P options on futures. So it's nice to be able to get a spread and not pay for it. Last but definitely not least, the expected move. So the SPX this week, okay, I got to tell you, with everything that went on, CPI, PPI, everything's coming out hot, people. Okay, inflation is back. You're like, how come this marketplace is not breaking loose? It's not breaking loose because everybody's trading those short duration options. For right now, it's suppressing volatility. The exact opposite will eventually happen. You can only cage the animal for so long. You better keep that in mind. All right, this next week of trade, we're actually going to go from $104 expected move. That was the previous week. And by the way, this previous week, look, okay, not much action other than we had this chopped out, again, action. That's why I was explaining the 0 days to expiration. We didn't tag the upper and or lower edge of the expected move. The next week, okay, we only have a 4-day week coming ahead of us. We are off on Monday. It's President's Day. Some futures are open, but the equity markets, bond markets are effectively closed. Looking 7 days out, people, we're only looking at about a $73 move. Think about that for a second. Only a $73 move. You do realize the ranges every day have pretty much been over $70. So again, hands and feet inside of the vehicle, because this 0-day expiration risk, I think the situation is presently coming to a head. Thanks everybody for joining us here at TheoTrade. Have a wonderful holiday weekend. Bye-bye.